Your Excellencies, distinguished guests, dear friends, ladies and gentlemen, it's a pleasure and privilege for me to welcome you all at this defining moment for this interesting and exciting conversation. It has to be interactive. We'll get together to see, with the changing dynamics, business is an opportunity, or is it full of challenges? We recognize globalization, re-regulation. What was once described as deregulation has become re-regulation. Technology and consumerism is redefining the global space. Extraordinary set of deliberations. Financial economies are still reeling under pressure, converting as real. Real economies are redefining the scope and performance. Communism has changed. Capitalism is altering its form and substance. Even after 7 years of so-called financial crisis, our global sustainability is at stake. Global growth is less than 2009. Extraordinary set of financial inclusion. The measures, the compliance architecture, the policy reorganizations are all getting defined and redefined. If you look at the bigger picture, the International Monetary Fund is predicting in the spring meeting and as well as annual meeting in October every year, the global growth. It defies all the logics as and when we look at numbers on a concurrent terms. The changing dynamics is compelling for us to see how do we transform this world to set in committed missions to eradicate extreme poverty. How do we set in gender equality? How do we make sure healthcare, universal healthcare comes in? How do we transform environment sustainability? How do we build this partnership to promote sustainability in global space? That's the deliberation we continue to have. The Millennium Development Goals has been set in as a sustainable goal. That's the reality. When Lehman Brothers was bankrupt and Bastion was bought out, we realized it was liquidity which was driving the constraints. We started printing money. The United States was the first one to recognize we need to have accommodative monetary policy as a substantive tool. Increasing the money supply can inflate the world. Otherwise, after 1930 depression, there was a possibility of total collapse. Unless we set universal standard in terms of accounting, valuation, securitization, we are not going to bring in global sustainability. That was a compulsions we have had to redefine this world, to transform this world, to create global sustainable growth. So we started printing money. The asset price inflation, where the stocks or properties, was responsive for a short while. The accommodative monetary policy has helped. Indeed, it helped. If America can print money, the rest of the world also realize they have to inflate their economy. Countries like Euro, enlarged Euro, as a design, was subject to a lot of risk. While the monetary policy is centralized, fiscal prudence is without order. That's decentralized. Every single country had their own fiscal framework, and alignment was a bigger issue. So they started printing money through European Central Bank. Bank of England started doing the same. If these countries, global powers, can do it, Japan, which was technically under recession, wants to pull out. 3 years before, Abenomics was set in as a convergence of politics and economics. And again, they started printing in the open market operation, trillions of yen, stimulating the economy, export-driven economy. We saw the reflection for a while. The global growth is trying to come back to normalcy. The heterogeneous monetary policy has triggered extraordinary set of asset price inflation in certain parts of the world. America realized in 2014 they have done enough. They stopped printing money, and it was time they have to raise the interest rate. Housing market was recovering. Purchasing parity was improving. And we also realized there's an extraordinary opportunity to differentiate America from the rest of the world. So they were contemplating options through Federal Reserve, time and again on the FOMC meeting, that they should raise the interest rate. 1.5 years of lingering, and again, diverse opinions. And it was premature in my personal pursuit of profession. I've been saying this time and again. While it was defined as a global problem, prematurely increasing the interest rate can cause extraordinary volatility in the financial market condition. Precisely what happened. The deceleration in the rest of the world started ever since America set the eyes on interest rate. And December 25th, when America started raising the interest rate, at least telling clearly what they plan to do 4 times, they are going to do it in 2016. The compulsions were there to speculate in the gambling financial markets. We have seen the reflection. The entire financial market was in carnage. The stock market was completely under red zone, including United States, Dow Jones or Nasdaq or Paris CAC or London FTSE or Japanese Nikkei. The asset price inflation apart, housing market was said to be recovering. Uneven growth was visible even in the United States. Quarter after quarter, if you look at the economic momentum, it was not sustainable. While IMF was predicting clearly they're going to put not less than 3.6% as annual growth for 2016 when we met in Peru, Lima, it is not visible now. It is not visible how global growth is going to be anything more than 3%. And again, Americans have realized, is it the right time to rise 4 times this year? They pulled back last week. They said maximum of 2 times. Meanwhile, you are seeing the reflection in the commodity market, stock market, currency market, bond market. Financial markets are nothing but gambling ground. That was a dictum, visibly showcased, highly speculative. This year was extraordinary for any institutions. Globally, we were feeling the pinch. Technical recession was visibly showcasing. Again, as Mr. Yusuf was mentioning, we have a reflection of negative interest rates. Whether America needs negative interest rates, time to answer. We have also seen there's nothing wrong absolutely having a negative interest rate, whether it's Japan or Euro. But how do we bring in stable and functional financial system? How do we improve an orderly growth, gradual growth for the global economic recovery? How do we set in universal standards to have inclusive growth? How do we make sure the global economy is producing gross welfare to the mass, whether it's developed world or developing world? How do we improve the trade? How do we improve the investments? How do we improve the banking systems? How do we make sure financial systems is not endangering its solvency for human crisis? These are some of the questions we need to answer. That was the global picture. What about the region? Where we have 45% of the world oil, 25% of the world gas comes from, we have seen the reflection in this region. Gone are the days where we used to have 1.8 to 1.9 trillion. Gone are the days where 17 years we have oil costing over $100, where convertible investable surplus visibly was invested as a diversification, as a structured solution in multiple markets, in multiple sectors. Reflection of the financial market, reflection of the currency being administered was visibly shaking the Gulf-driven economies. It is from 1.8 to 1.9 trillion, it regressed to 1.4 trillion. If you look at a split, Saudi Arabia is topping in the list with $643 billion, taking oil at 45. IMF said United Arab Emirates should do not less than $357 billion. Qatar should do next $192 billion. And Kuwait should do $127 billion. And $60 billion goes to Oman, $32 billion goes to Bahrain. Sum it up, it's 1415 with a current account deficit of 2.15%, 35 to 40 billion. But what was the reflection in reality? The oil price went to $26. Gone are the days where we have had a current account surplus and fiscal surplus and investable surplus. We have moved from surplus to all the states are getting into rough weather, getting into deficit financing, a liquidity stretch. committed, expansionary, a fiscal framework, expansion in terms of road, rail, airport, seaport, modernization of urban development, all these are put to test. Can we continue the expenditure spree? How do we improve the revenue stream? How do we sustain the Gulf economy? How do we make sure we have a revenue stream getting realigned? How do we contain the cost, rationalize the fiscal framework? These are the questions we need to answer. So, the contingency really revealing enormous amount of stress in terms of a property price. We have seen the reflection in Dubai, 6 to 7% property price down, Abu Dhabi 3% down, and we have seen the reflection in the stock market as well. Complete carnage. All the stock markets till 2 weeks before were in red zone. Now we have seen the semblance of a recovery. Why? The OPEC and non-OPEC came together. They have realized they have to put a production freeze. There were speculation on the supply glut, rightfully so. Iran was extraordinary, in terms of the framework, compliance architecture, as the Western economies have set in for compliance of the various political agenda. And if it comes to reorganization, supply will increase. But what will be the realistic measurements? There are experts sitting behind me to elucidate. But we have to realize, is an end of the world? Is this all gloom and doom? Do we have recovery opportunities? What about United Arab Emirates? What about Qatar? What about Kuwait? Rating agencies have their say. Out of the 6 states, they are downgraded 3. They kept or reaffirmed the ratings for 3 of the Gulf states. Again, it was subjective. Subject to alignment of monetary policy and fiscal policy, subject to oil price, subject to the geopolitical makeup we have. That's the dictum rating agencies started saying this. There is an element of substance into it. There's an element of caution into it. And we have to recognize this challenge. But the challenges are always comes with opportunities. We have to recognize this. If you realize Saudi Arabia has been downgraded to A-, Oman was put to BBB-, and again, Bahrain was put to below the investment grade. It's a junk grade, to tell the truth. But they could manage to have maximum borrowings at a time when it was pronounced in the market space, they had oversubscription of the sovereign bonds. It's not that. World is not understanding the financial stability of the region. They can't recognize the opportunities. And that's what precisely we want to put across. While Qatar has been reaffirmed with AA, Kuwait has been reaffirmed with AA, and UAE has been reaffirmed with similar ratings. If you look at the fundamental economics, they have ability to hold their parity linked to dollar, and they also have ability to make the current account payments. Qatar can hold it for not less than 4 years. UAE can hold it for 15 months. Kuwait can do it for 17 months to defend the current account payments. They also have a monetary base to defend the parity-linked dollar alliance. These are equities which we have to recognize in recognizing the opportunities, specifically coming to UAE. This is the most diversified economy we have to understand. We understand over 68% of the GDP breakdown, if you look at it, it's non-hydrocarbon. That's an enormous strength and resilient built model when it comes to functional makeup of UAE economy. We also recognize that the trade or banking, finance or investments, we have a bigger opportunity to integrate in substance and see it and seize it for us to make the most out of it, whichever be the function you are engaged in, whatever be the sector you as a businessman responsible for. How is it possible? What is UAE economy in substance? 356 billion, I mentioned, as a GDP. If you look at the growth as propelled by IMF, it is 3.1%. Discounting 0.5% in view of the current deflection in the oil price, it will do not less than 2.5 to 2.6%. Is it going to generate current account surplus? Possibly no. Is it going to have fiscal deficit? The answer is yes. How much? 7.5%. What about trade? Extraordinary momentum in the trade. Today, if you look at global ranking in terms of trade, UAE stands very tall within the Gulf definition. $456 billion. If you look at the best performing economies, GDP versus their trade, genuinely, it is less than their GDP. The growth is more than the GDP. Over 10% last year, trade has improved, export and import put together, and it is ascending year after year. So trade is very solid. And the free trade agreement which UAE has engaged with Singapore was a telling story. A free trade agreement engaged with the Scandinavian in 2009, some of the Scandinavian countries, not all, is a telling story. And free trade agreement which is getting negotiated with European Union countries is again a possibility. Trade side, perfectly balanced. When it comes to industrial side, the growth is 15%. And we have compelling evidence for us to see industrial investments are growing. If you look at the total projects in the Gulf space, the maximum projects are assigned to UAE. 159 billion is the total projects spelled out by a fiscal framework last year. So the bids are likely to be $160 billion. If you split, 56 billion goes to UAE. And again, it is 24 billion for Qatar, 25 billion for Saudi Arabia, 17 billion for Oman, and 6 billion for Bahrain. If you sum it up, you can see the rest. There is definite opportunity. The maximum investments is going on the project space. If you split the 56 billion again, maximum goes to chemical. Then comes construction. Over 30, if you look at 35 billion between construction and chemicals. Non-hydrocarbon is only 13 billion. Water, power, all put together the balance. That's an opportunity which you can recognize. Airport, seaport, road, rail, 2020 Expo. These are all coming here. We have to understand. So the project space is full of opportunity. Contract space is full of opportunity. Whether you are a trader, it's an opportunity. When it comes to recognition of the banking system, it's very solid. Again, if you look at the financial stability of the economy, underlying fundamentals of the economy, vis-a-vis the banking capital adequacy, it is very reasonable. Of course, we had a lot of debacle last year in terms of small and medium-sized entrepreneurs. As a practitioner, I can tell you, we burn our fingers marginally. That's part of the evolution. This is the only country which produces over 60% GDP in terms of small and medium-sized entrepreneurs. That's an opportunity. That's likely to grow to 70% by 2021, according to National Development Statistics. And that's where we are seeing the backbone of the economic momentum. There are issues. There are market liberalization. There are single window clearance. There are opportunities. And that's what we need to integrate in real order. While banking is solid, while trade is solid, investments, if you look at the project space, if you look at the budget, federal budget, 48.1 billion Abu Dhabi dirhams, is split, is visibly showcasing enormous opportunity for this fiscal year. Dubai itself, with a zero deficit, they're going to spend 46 billion Abu Dhabi dirhams. That clearly shows how much depth is there in terms of diversity. And that's what we need to recognize. While internal integration is required between the Gulf states to set in reorganization in terms of revenue stream, if the oil price goes below this level, or if there is continuing regression on account of alternates or other options, then we have to find solutions. That's why they had dismantled the subsidies for petros. That's why there is a possibility from January 18 onwards, GCC-wide VAT coming in. Those are medium and long-term solutions we need to bring in for revenue streaming to make sure sustainability in terms of revenue as well as cost comes in. Those are the opportunities we need to elucidate. We need to understand. So, is it a crisis? No. Is it a challenge? The answer is yes. Is it measurable, manageable, and controllable? The answer is a firm yes. And that's what the message I want to tell you. And that's what the recognition we all need with a cautious optimism. If we map these challenges into business process and redefine your business model, that's the message. If you redefine your business model, not business as usual, you redefine your business model to make the most out of it, you can. Together we can. And that's the very purpose of today's knowledge sharing session. The purpose of me bringing a light speakers is to recognize this challenge and make sure you make the most out of it. With me, such wonderful speakers. I have a privilege of having Mr. Ziad from INOC, Managing Director of INOC. And again, he's going to tell you what's the current scene in the oil price, what's likely to happen in real terms for the futuristic options. When it comes to practitioners, businessman, Mohan is a profound, successful entrepreneur. And it's important you listen to him. He is correlating his thoughts with Singapore and what sort of change and knowledge management, knowledge society we need to bring in. And that is his statement today. Corporate finance plays a bigger role. With all these changes, what's likely to happen in terms of macroeconomic stability? How do we borrow? How do we lend? How do we use the changing dynamics to our advantage in terms of financial markets, stocks, currency, or commodities, or bonds? Those are the dynamics which Mr. Javed is going to bring across from PwC. That's the evening for you. I'm sure, along with me, you will have an enjoyable evening. Thank you, ladies and gentlemen, for your kind attention.